Welcome to the CIO Chair, a podcast hosted by the CIO Investment Club in collaboration with the Pension Insurance Corporation. In each episode, we will sit down with top chief investment officers to explore their unique investment philosophies, decision-making processes, leadership strategies, and personal career journeys. Now let's get started. Welcome everyone to the CIO Chair, hosted by me, Sean Thompson.
And me, Hartej Singh.
The CIO Chair's guest today is Gerald Chen-Young, Chief Investment Officer to the National Public Pension Funds Association, a US-based non-profit organization focused on supporting public pension systems, deferred compensation plans, and the professionals who oversee them. Gerald has over 30 years of experience with major global financial institutions. As well as being a CIO, Gerald also serves as a board trustee, an advisor to a global securities law firm, is a director of a global insurance fund, a board member and chair of the investment committee to a Chicago-based group of insurance companies, and more recently has just become an adjunct professor at Georgetown University. Welcome to the CIO Chair, Gerald. It is a pleasure to have you here. And as I say to all our guests, I hope you are sitting comfortably.
I am indeed. Thank you. It's an honor being here. So thanks to you both, Sean and Hartej.
Fantastic. Thank you so much for joining us, Gerald. And obviously you're well known to us, but if you could, just for the sake of our listeners, tell us about your role and your organization.
Sure. So I am, as Sean mentioned, the Chief Investment Officer for the National Public Pension Fund Association. We have an internal portfolio that's just about $1 billion. We have members that are comprised mostly of police, fire, and teacher pension plans. And altogether, our membership has about $1 trillion in assets under management. My role as CIO is A, managing the internal $1 billion portfolio, and B, advising our members regarding all sorts of matters related to their investment strategy.
That's fantastic, Gerald. So as CIO, there's obviously been a path of education and other roles you've taken on the way. Could you please help us sort of track that journey between then and now?
Sure. So by way of education, I have graduate degrees, postgraduate degrees, I should say, in both law and economics. In economics from the LSE in your great city of London, and also York University in Canada. And in law from the University of Miami for the JD, as it's called here in America, and the LLM from the Washington College of Law.
Well, that's fantastic. Economics and law often sort of go very well, but often they're practiced by different people. Given you have both, tell us a little bit about that intersection and how that's been an advantage in your career.
So when I finished the master's at York University in Canada, I had to decide, in economics that is, I had to decide whether to do a PhD, which would be the next logical step, or something else. And what had happened in my thinking was economics had become too mathematical. And I was never one prone to thinking that human beings and their behavioral patterns are reducible to a series of difference or differential equations. Meaning, to get convexity within difference curves, as you know, you need certain axiomatic assumptions. And the axiomatic assumption regarding all of economics is, plain and simple, rationality. That human beings are rational and we behave rationally. The problem is, as game theorists will tell you, human beings do not always behave in that manner. So instead of doing a PhD in economics, I opted for the law. And in so doing, I sort of conceived this idea that the rational person from economics could meet its equivalent in law, which is the reasonable person. And I thought that that marriage of rational person with reasonable person would work well. And it's proven to be that way.
So with all that, with the rational and reasonable education, what was your career from there?
In 2 words, well, 3, global monetary policy. My dissertation for the master's program at York University argued that the countries of the British, the Commonwealth countries of the Caribbean, So where I'm from, Jamaica, Barbados, and Trinidad and Tobago, should have all relinquished their home currencies in favor of adopting the US dollar as legal tender. I made that argument in 1992/3. And for my master's dissertation in law, so the LLM, I argued that the Securities and Exchange Commission and the Commodities Futures Trading Commission, the CFTC, SEC and CFTC respectively, should be merged. I still maintain that. And in the context of your question, I maintain both dissertations as applicable in this day and age.
That's fantastic. So from such a deep educational and doctoral sort of approach, where did it go from there?
So, in terms of work, I started off on the sell side of our industry, the investing world. I started off doing retail banking with what was then called the Riggs National Bank in Washington, D.C. I then moved years later to Payne Weber, if you're old enough to remember the brokerage firm, Payne Weber.
Absolutely.
And
I'd like to say no, Gerald, but unfortunately I have to say yes.
And in fact, we had an office in your great Finsbury Park, which is in the city.
Yep.
So sell side Riggs, sell side Payne Weber, sell side UBS, the Swiss bank. And then I made the switch from the sell side to the buy side. I moved from being a retail broker as a vice president at UBS to becoming the chief investment officer at an endowment called the UNCF.
And what does that mean?
So the UNCF is an acronym for the United Negro College Fund, which was formed in the 1940s and provides higher education funding for minority children. And after UNCF for 14 years, running their $1 billion $2 portfolio, I moved out on my own doing advisory work with several organizations, including an Ivy League university, a European conglomerate, and a few others. And eventually, I was asked by the National Public Pension Fund Association to join their board. And after a couple of years there, they asked me to be or move from being a board trustee to being CIO, which is where I am now. So to answer your question again, Hartej and Sean, it went from moving from the sell side of our industry to the buy side.
So often that's considered quite a difficult move to move from the sell side to the buy side. Could you explain what drove that for you? And was there anything in your early career or indeed different roles you'd taken that made that transition smooth?
On the sell side, as the name suggests, obviously you're managing portfolios for a whole host of individuals, companies, nonprofits, etc., etc. But in essence, you're helping investors structure their portfolios, whether it's for retirement or otherwise, scholarship funding, etc., etc. On the buy side, slightly different. The same relations I had with money managers all of a sudden switched from me being pitched, pardon the term, by them to now me being an ally.
Which side did you prefer?
Interesting. Wow. It depends. It depends. I have to say, I can't say one is better than the other. One was. They have different merits. On the sell side, your obligations are different. On the buy side, you have more interaction with peers, I would say. If I had to differentiate between the two, the buy side has more interaction with peers.
That makes sense. And during like it feels like there was a very clear sort of movement from the sell side to the buy side, but you've also done sort of a number of things on both the sell side and the buy side. Were there any lucky breaks in this journey of yours?
So I'm glad you asked. Lucky breaks. Definitely, sell side to buy side is a unique opportunity. That's not common. Another lucky break. The application of the dual education, the reasonable person and the rational person. That's factored in mightily in my career. Thirdly, the quality of peers and people. I find myself now learning from fiduciaries, trustees, and fellow CIOs, much more than I did on the sell side, and constant critique and input from peers. So those are the attributes I'd say that the lucky breaks merit or qualify as.
So that's sort of your career to date, and it feels like you've done so many different things, which actually is a feature of a number of the other CIOs that we've interviewed. So now, if we can move on to strategy and style, We note that you've worked at several different type of firms with different investment objectives. Could you give us an overall thought about how this has impacted the way you think of matching assets and liabilities?
I would begin by saying you need to have, or one needs to have, N different mandates for N different pools of assets. And there needs to be that sort of clarity, which goes to the concept that you iterated or intimated of matching assets with liabilities. Different pools of assets have different term structures of liabilities associated with those pools of assets. And you need to be mindful both as an operator, a fiduciary, and a trustee.
And the role that you currently play as both CIO for the NPPFA and also working with their members to help them look at their investments and set their investment policies. How does it work side by side?
Our members are obviously pensioners, right? Police, fire, teachers. For the internal portfolio, we have constant contact with regular meetings via regular meetings with our internal staff, right? Our internal members. And for the ones that we advise on, we meet on a quarterly basis and we discuss the structure of their different liabilities and differing liabilities. I believe when you were in Wisconsin earlier this last summer, you met some of our members and you could tell that there was a difference between again, I use the term structure of liabilities. That sort of minutia is something that we are very mindful of. And through our board and our membership, we constantly engage in with the outside managers and advisors and consultants.
So you're acting alongside with the investment consultants at those pension plans, acting as a sort of OCIO, or is it very much from an advisory perspective that you keep it separate?
That's a great characterization. It's a little bit of both, with the latter being de facto, meaning we're not employed or hired as OCIO, but it's de facto through our role as advisor or advisors. And by the way, since you also mentioned this, we think of the management of these pension portfolios as having a triangular structure. One prong of the triangle is the obvious asset owner. The other prong of the triangle is, let's say, a litany of consultants, accountants, etc., etc. The third prong is obviously the fiduciary slash trustee slash CIO. So at the apex, we have the CIO, trustee, fiduciary element, and then we have the asset owners alongside the consultants, the accountants, etc., etc. So it's a triangular structure.
And how does with all the different types of firms that you might be acting on behalf of or working with, how do you shape the differences around matching assets and liabilities?
So if we focus on the second or third prong, depending on which one you choose to, outside consultants, advisors, and obviously managers is something that is mostly led by the investment policy statements of each different portfolio. I know that most IPSs, to use the acronym, have certain things in common, but there are differences. And the differences are what we work through with the individual managers on that third or second prong of the triangle. For example, some IPSs don't permit use of leverage or margin. Others don't permit unconstrained mandates. Others permit long-only strategies with very well-defined benchmarks, S&P 500, for example. So that sort of idiosyncrasy is what we work through with the various managers on that second or third prong, depending on how you structure the triangle.
To go back to your original point, given N different mandates, the structuring of investment policy is obviously a key part of setting up an investment policy statement is a key part of setting up the mandate. What about its limitations? Where have you found that the IPS has been stretched or strained such that more dialogue is required?
That's interesting. I suppose on a philosophical level, it's recognizing and getting buy-in, meaning literally getting buy-in from the fiduciaries and trustees into the notion that an IPS is not a catechism. It's not etched in stone, thou shalt not, blah, blah, blah. An IPS is a guideline. It's a series of guidelines. And getting buy-in from the fiduciaries is one of our biggest challenges. But I think we're fairly successful in doing that and getting that.
Is there an example where you've had to effectively respond to either an investment opportunity, a risk, or some sort of extreme event where an investment policy was changed in a relatively short timeline?
I wouldn't use the language changed. I would simply use language like exceptions were made or provisions for exceptions were made. An example or two that come to mind are in two different phases of my career. In 2008, during the financial crisis, the IPS of that organization I worked with mandated that we invest in government fixed income securities only, so treasuries and agencies. When TED spreads, which, as you both know, are the difference between corporate credit issues and government issues, when TED spreads were at their highest in memory, I went to the investment committee and simply said, this is a so-called tail event, a black swan or a gray swan, depending on which language you prefer. I said, corporations like Procter & Gamble, General Electric, GE, IBM, Coca-Cola, JP Morgan, I said to the investment committee that those massive corporations, not even Fortune 500, I'd say Fortune 20 in terms of scale and influence, I simply said that they're not going anywhere. And I said to the committee, I realize the IPS, technically speaking, restricts us to just government issues in the fixed income world. But I said, I thought that maybe an exception could be made. Not a changing of the IPS, but an exception. And it was unanimously accepted. So we ended up liquidating the majority of the book of, practically all of the book of government securities, and rolling those assets into corporate issues, investment grade, again, the likes of the GEs, the Procter & Gamble's, JP Morgan's, and so on. And that trade paid off so handsomely for the company that to this day, we're still living off of it.
What an entry point. Yeah.
Well, that was one example. I mentioned two. The second was during COVID, more recently. Once again, we had a book of securities, and as you know, I chair the investment committee for a group of insurance companies, and those securities were mostly, well, the majority, majority fixed income. The 10-year Treasury note here in America fell below 50 basis points. 0.49 to be precise. Again, I pointed out that this is another black swan, a gray swan, a tail event. Again, the nomenclature changes, but the principle doesn't. In other words, it was a unique opportunity. And I went to the committee, some members of which and whom, Sean, you've met. I said, we need to capitalize on this. And what did we do? We liquidated the book of fixed income securities while the 10-year Treasury was under 0.5%. We sat in cash for a while and then redeployed back again to the consistent IPS guidelines. So in both examples that I've outlined, I wouldn't say that we, quote, changed the IPS. We simply carved out an exception during tail event occasions.
It's interesting, Gerald. Sometimes, talking about insurance firms just there, but sometimes those insurance firms are concerned, worried to actually change quite considerably their investment portfolio, even because of those types of events, be it COVID or others. I mean, was it that easy for you to be able to make those changes and for the board to agree with what you were proposing? Because I think sometimes you come across boards that are, it's not what we do, it's not how we do it. We want to stick with what we know and therefore continue.
I wouldn't characterize the exception as being easily made or easily accepted on the one hand. On the other hand, I simply presented the evidence from an empirical standpoint. We had never seen the US 10-year Treasury at those levels, certainly not in all three of our lifetimes.
And I think it's right. You have to have those conversations and those discussions and make those changes when things like that happen. And I think it's right for you to have those conversations and agree with the board that there are times like that when you need to think about making changes. Just following on the strategy and style, I mean, how do you think about diversification? in terms of types of assets that you might invest in. And I appreciate it will be different for the insurance firms that you look after versus the pension plans, but just interested to know how you see diversification and the importance of it.
Well, I mean, to use an old adage, eggs in a basket. Diversification is paramount. And again, if you embed that notion of diversification with the structure of the liabilities, PNC insurance type entity, meaning property and casualty, is different from a life insurer, and so on. So diversification is paramount, and it's driven, pardon that expression, because I realize LDI in the context of certain UK quarters is not handsomely or favorably smiled upon in light of what happened a couple of years ago. But I mean LDI using common L, common D, common I, some lowercase, as we say in America here.
And what about the role of private assets in terms of diversification? Do you see them as diversifying from public markets, or do you see them as similar risks taken in a different format?
That I would answer as being a function of the risk appetites of the fiduciaries and trustees. On an academic level, private equity is equity. But on another level, private equity is a different animal in terms of its characteristics from public equities. There are things known as J-curves, lockups, side pockets that public equities don't have, which means the fiduciaries and trustees have to be mindful of what those things are and do to the portfolio. Yes, on the one hand, an argument can be made that private equity lowers volatility, for example. But as I've published many times over the years, and it's in the public realm, I find that people that make that argument are using private equity somewhat as a camouflage for volatility, meaning just because you don't see the marks day to day, meaning mark to market, doesn't mean that there isn't underlying inherent volatility in the asset class. Take real estate, for example. In certain neighborhoods, certain zip codes as we have in America, or certain boroughs in England, for example, the private equity valuations fluctuate. You just don't see the marks the way you do when you look at the FTSE. And in that sense, it's somewhat of a camouflage. But I go back to my original remark on this, my opening comment on this subject. That's a function and role for the fiduciaries and trustees to undertake.
So just going further on from that then, I mean, how do you make sure that there's an appropriate amount of risk being taken within the portfolios? And are you frustrated sometimes that maybe the members you work with, the pension plans, the insurance firms, don't take as much risk as you maybe would like them to?
So the answer begins with your definition and concept and characterization of risk. Which risk are you referring to? Are you referring to operational risk, liquidity risk, going concern risk, and all the metrics associated with all three? And again, I go back to the governing body, right, the owners of the assets, the trustees and fiduciaries of the assets, to make that determination in conjunction with the operational people. The operational people at an endowment, a university endowment, for example, are primarily concerned with funding scholarships, different from the operational people at an insurance company, whether it's property and casualty or life. And by the way, we can extrapolate to all types of institutional portfolios. Sovereign wealth funds have different risk characteristics. Pensions have different characteristics, and so on. So it begins with the governing body and how they define and outline their risk profiles. It begins there. And that really is an ex ante determination, not ex post.
And given sort of we're talking about diversification and different assets, sort of one of the key transatlantic, or at least perceived transatlantic differences, is the approach to responsible investing. So, for example, investments in oil and gas or defense. Does that question come up much with the people you work with, or is that something that is much more idiosyncratic to the certain institutions?
So that's an interesting question, and I would say a little bit of both. Concepts like ESG, PRI, and SRI that you've alluded to has fallen into a certain light, to put it politely, here in America. Some states, for example, and this is in the public record, states like Texas, Florida, and a few others have literally put in a ban in their mandates for asset managers, meaning if you want to manage any of our public pension assets, you cannot have ESG, PRI, or SRI in your mandate for our portfolio. That's in the public record. But the reason why I say it has elements of both is because it's slightly contradictory or self-contradictory. Here's an actual example. I was speaking at an event in somewhere in California, or I can't remember, Arizona it could have been, I can't remember. And I flew through Dallas-Fort Worth Airport. On the one hand, the governor of the state of Texas issued a mandate, an edict, banning asset managers. It's in the public record. And some are named. JP Morgan was named. BlackRock was named. And Blackstone, and so on. Banned, meaning prohibited, those asset managers from having ESG in their mandates for managing public assets, right? So pension assets of the state. That's on the one hand. On the other hand, going through DFW, right, Dallas-Fort Worth Airport, there was a placard on the wall. I actually saw this, an outsized placard, something that caught my attention, that simply read, "We will be carbon neutral by the year 2030. So here on the one hand, you have the governor of the state saying that we're banning, forbidding these types of mandates, yet the largest employer, at least public employer, or one of the largest in the state, advertising that they'd be carbon neutral within the next decade.
Crazy.
Which is why I say it's slightly contradictory and why I mentioned both.
Very interesting. Very interesting. I'm just thinking about the sheer proportion of US assets in the global investment universe. How do you think US pension plans, US insurance firms that you work with, how do they consider looking at the global geographic diversification when investing?
They have to. I mean, it's part of their mandate to narrowly confine a pool of assets to just one country or one region or one entity is a disservice. But just one other point I'd like to make regarding ESG, PRI, SRI that I forgot to mention. Lest anyone think that that's purely a philosophical or sentimental matter, need only look at the empirical evidence showing and supporting that ESG, PRI, and SRI investing is prudent investing. If you Google the S&P 500 index ESG versus the original S&P 500 index, just the ordinary, you will see that the former has outperformed the latter. Similarly, if you Google MSCI, and they don't use ESG, they use PRI, if I'm not mistaken, or SRI, forgive me if my memory is foggy. Again, the former has outperformed the underlying latter, which means there's an empirical case and argument to be made for ESG, PRI, and SRI being prudent investments. That said, going now to your point, or your question, Sean, regarding global investing. Here I would point to the example led by sovereign wealth funds. Those giant pools of assets have almost implicitly embedded in their mandates the obligation to invest responsibly. Again, going back, I'm connecting two dots here. Geographic investing with SRI, PRI, ESG. And if you look at, for example, take the news this morning on Bloomberg. Earlier, I saw this. The Norwegian Sovereign Wealth Fund is divesting a chunk of your assets, UK assets. So here's an example of the largest sovereign wealth fund in the world, assuming it still is. But here's an example of one sovereign wealth fund divesting a portion of its assets from specifically the UK.
And I guess whilst we're on the topic of the UK, what is the perception of the UK, or if it's a more broad European sort of perspective in terms of a way of diversifying globally?
Brexit being back in play, or the notion of Brexit, financial market capitals, London, meaning UK, v Frankfurt, v Paris. Thirdly, AI capital of Europe on the IT side. And fourthly, IP capital of Europe, intellectual property. I'm thinking particularly of Cambridge University. So when I think of the UK as an investment option, those four themes come into play. Is Brexit back in play? Some quarters suggest it is. Whether London has been dethroned, displaced by Frankfurt is another. AI.
Is the AI theme the fact that sort of the UK and Europe have not been a significant part of either the investment flow or the sort of idea generation within that area?
I think there's a race within broader Europe, I'm now including Europe, UK in the broader Europe discussion. There's a race to become that. Which of the capitals in Europe will be the leading entity?
I guess, does the lower forecast growth rates for the UK and Europe versus the US, so, let's call it broadly 2% plus or minus in the US and broadly 1% plus or minus in Europe, is that enough to dissuade investors to deploy capital there? Or do they believe that valuations warrant?
Okay, so you're raising a broader issue here. I think, as I've published again in the public record, that we are in, for want of a better term, global stagflation. And I think Europe in particular is manifesting it. And some of the language from the ECB president, Madame Lagarde, would suggest that's not too far off of an assessment. But just on the UK, focusing just on the UK, yes, I'm seeing slowing growth. The data support that contention. There's not much sign of inflation, but prices are sticky downwards. So inflation may not be rising or rampant, but there is slowing growth and there is an elevated element of prices in the UK, as I believe worldwide, hence the term global stagflation.
That makes sense. And broadly, let's say Europe has its challenges with respect to stagflation. What about emerging markets as a source of diversification for US pension portfolios?
Wow. Well, Hartej, that concept, that notion, EM, coined by one of the giants in our industry, Jim O'Neill, right, the former head of Goldman Sachs Asset Management, who I believe now heads the Chatham House in the UK, coined the acronym BRICS. So Brazil, Russia. Many years ago, I spoke at the German Stock Exchange in Frankfurt. In fact, I spoke 2 or 3 times there. And I brought up a concept which was slightly audacious, slightly. I raised and again, forgive me for this indulgence. I raised the point that if a Martian landed on Earth, God's good Earth, and that creature began its sojourn at Shanghai International Airport and traipsed its way westward, country by country, ending up at JFK International Airport in New York, here in the US, I doubt that that creature would conclude that China and some of the other countries were quote unquote emerging and that we were developed.
Yeah.
So it's an audacious suggestion, but I'm drawing attention to the fact that EM as a concept may be, meaning in its nomenclature, may be a misnomer.
Yeah.
And if not a misnomer, an anachronism. Remember, the World Bank and the IMF coined similar language, at least when I was in school, such as LLDC, LDC, right? Less developed countries, least of the less developed countries. The World Bank and the IMF gave credence to those acronyms. And it's morphed to now what we refer to as BRICS. Nevertheless, the concept, in my view, again, very respectfully, without hopefully being too audacious, my view is that that's somewhat of an anachronism. It doesn't apply.
Is that adopted by how investment portfolios are allocated, or is that sort of awakening to the changes that have happened coming?
I mean, that goes back to our earlier discussion of the IPS not being a catechism, etched in stone, in other words, versus a guideline, a series of guidelines. And if you are dogmatic or doctrinaire in your adherence, following of the targets and ranges in your IPS, if you're dogmatic or doctrinaire, then yes, you may be lulled into making allocations into anachronisms like EM, emerging markets. On the other hand, if you're slightly forward thinking, you may want to recharacterize those investments. And if I had to very humbly say, country by country, not dissimilar to stock investing. characterize a country, evaluate its worthiness based on the fundamentals of that particular country.
Perfect. And I'm now going to go back to the fact that you've just become a professor, an adjunct professor. And given the fact that you now have two hats in some respects, how do you see the role of academia going forward in developing the next generation of investors? Because obviously you've just taken on this new position. It's clearly very important to you, having spoken to you about it recently. So I'm just intrigued to know where you see that all fitting.
So it came as a pleasant surprise when I was invited by Georgetown University, which is literally, not even 10 minutes from my house, to take over this class as an adjunct professor, the class entitled Asset Management. To answer your question specifically, it's been such an honor. It's also been an awakening. I never realized how much work in terms of preparation being a professor, even though I'm only adjunct and part-time, so it doesn't interfere with my quote-unquote day job. But I've never realized how much preparation professors put in for a class.
You haven't done the marking yet, Gerald.
Not yet, but I have given them a schematic regarding how the grades will be determined at the end of the semester, end of the term or semester, depending on which language you use. But I will say this: I had my first class last Wednesday, literally, so
Yep.
5 days ago. Do you know what my first assignment was? Please watch the following: The Big Short, Margin
Yes.
Call, Wall Street. Those, as you both know, are Hollywood productions based on reality. That was my first assignment. Watch those three things. So what I did in the class was I presented the syllabus on an overhead display. And I ran through the syllabus to give them, quote unquote, a roadmap of where we were going this semester. And on the penultimate page to the roadmap, I had a specific section outlining class by class, henceforth, what we'll be doing. The end of the first session was what I entitled Movie Night. That's literally what I called it. I said, go and watch those three flicks, not with an ear towards the romance or the grandiosity or right. No, go and watch them for what's happening technically regarding our industry, investing. Do you know that last Thursday I had dinner with a friend, and this person said, Gerald, I was lead counsel on that case involving The Big Short. So I'm not going to divulge names, neither the firms nor the people. This person said I was lead counsel. I asked my friend to carve out even 15 or 20 minutes to attend my second lecture day after tomorrow as a surprise guest. So imagine being a student, and these are fourth-year students, so they're graduating in May, having been assigned to either read or watch, again, going back to their disciplines and their proclivities, down The Big Short,
Yeah.
Wall Street, Greed is Good, if you recall Gordon Gekko, and so on. Imagine being a student in class and then having the class interrupted by a guest appearance. By the way, ladies and gentlemen, fellow students, this person was lead counsel on the case involving this particular firm. Again, in the interest of privacy, I will not divulge, but you can fill in the blanks and I'm sure you can guess. Certainly the firm at a minimum, it's in the public record.
You're going to become a very popular professor very early on in your career, Gerald. We're coming to very close to the end. I suppose a question that I have for you is, what would you want your legacy as a CIO to look like or to be?
Well, first of all, to set an example for excellence, being able to withstand the harshest of critiques and criticisms from peers, but also having publication, literally and figuratively, right, in the public realm, work that withstands the test of time. So, in essence, your reputation and the quality of what you've delivered.
That's fantastic, and we hope you achieve to that aspiration. And so, whilst we're on the topic of inspiration, what's one book, podcast, or idea that's influenced your thinking?
I actually, in my reading requirements for the class, and I didn't use the adjective requirements, I said suggestions. I actually asked the class, swear to God, show of hands, those that are interested in this industry from a serious professional life choice. And I actually narrowed that question to ask whether you're interested in the hedge fund space. And a few hands went up. Not all, but a few. And in that case, I said, in that case, you have to read a beautiful piece from one of your compatriots called Sebastian Mallaby, entitled More Money Than God. That is on my required list, and it's on the syllabus that's published on my LinkedIn page, as well as on my Georgetown University faculty page. More Money Than God, Sebastian Mallaby, whom, by the way, I met, and he autographed a copy for me since, but I've since given it away. But More Money Than God, if I had to single one out. Beg your pardon, no, one more.
One more.
Again, one more. I was asked to speak at an event in Montreux, in Switzerland, some years ago by a group called, oh God, Gerald, what's the name of the group? Not Institutional Investor. I forgot. It was one of these reputable, well-known groups. And I was asked to speak on an essay that I loved. The title of the essay, again by two Brits, your compatriots, the title is The British Origins of the U.S. Endowment Model. And I'll end by saying it began with the creation of the first endowment by Henry VIII.
Wow.
Interesting. You're so knowledgeable, Gerald. It amazes me every time I get to talk to you. Listen, it's been absolutely amazing. It's been wonderful. We always end with the quick question fire round. This is off the cuff. You've got to be quick. You won't know about it, but here goes. Favorite sport?
Football.
Football. Is that football, American football, or soccer?
I was just about to say, the Gunners are only, 7 points ahead of Aston Villa, given Aston Villa.
I was going to say, you got two Liverpool fans here, so I'm not too sure we're happy about
I was a Liverpudlian when John Barnes, my compatriot, captain of Liverpool.
Yes, very true, very true. Okay, favourite film or TV drama?
A Man for All Seasons.
Okay,
Strong.
Going back to Henry VIII.
Correct.
Perfect. Favourite drink?
Good wine.
Good wine. Favourite book, apart from obviously the two you've just mentioned? This is more probably when you're relaxing, when you're reading. What's your favourite book?
Thematically, biographies. And in particular, autobiographies.
Perfect. And last, your favourite hobby?
Cooking and reading. And as you both know, I spent some time at a school in Paris studying the culinary arts.
You did. I'm looking forward to that invitation to dinner. Listen, Gerald, thank you so much for being part of the CIO Chair. I hope you enjoyed it. We shall hopefully speak to you again sometime soon. So thank you very much.
Thanks so much, Gerald.
Thank you very much.
Thank you so much for listening. Be sure to stay tuned. In the meantime, follow the CIO Investment Club on LinkedIn, Threads, and X to stay in the loop about our upcoming guest interviews on the CIO Chair podcast. For more information about us, please visit our website at www.cioinvestmentclub.com.